Ahoy there, traders, and welcome, welcome, welcome. As always, thank you, truly thank you for just taking a moment out of your week and spending it with me. And to be fair, with everyone else. We've got a lovely little community building and growing here. So it is nice, and I just want to acknowledge the fact that you could be doing other things. So thank you for spending some time with me this week. We've got again, thanks for showing up early. Got a lovely group of regulars. Got one or two new people. I'm just going to skip down and say hello. Hello, Ruben. Hello, Dawn, Ian, Michael, Nick 3, Nick 4, several Nicks. And no iPhone users this week. Nonetheless, I'm sure some will appear. Scott, Vito, Ray. I think you'll recognize your name. I'm not sure if it's your first week, but nonetheless, welcome one, welcome all, and thank you for spending time with us this week. So we've got, I think we've got a fun-packed show this week. Fun-packed. We've got the main theme that I'd like to talk about throughout this this week's workshop is the correction coming? And shh, little whisper behind the back of my hand, it's always coming. So don't let the cat out the bag, don't tell anyone, but that's the secret. Nonetheless, we have a few other things that we'd like to talk about this week. Typical agenda, if you're new to these workshops, is, basically it's just me rambling about the markets for 20-30 minutes, basically giving my viewpoints of where we're going, what we might be doing. If we've got any trades to review, we'll review them. And then the main theme of what we want to discuss is the correction coming? If this is your first week with me today, I'm not a Wall Street guru. I've not worked in the city. I'm just one of these regular guys who managed to crack the code. I'm just a normal person who figured it out. The one thing that is true over the last sort of 25, well, I'm close to my third decade at doing this than my second now. But I am very passionate about traders and making them and helping them find their own path. A little bit about me. I've been trading full-time since 2001, hand drawing charts since the early 90s, calling most of my trades out in real time since 2004, manage private client accounts with assets under management of a little under 10 million at the moment. Specialized in Forex out of the last 25-ish years. And more recently, since about 2009, 2010, focused purely on stocks and stock options, and dabbling my fingers in the occasional futures trades. I am consistent with being able to help you replicate a proven production line process. That's basically my shtick. I've coached and mentored literally thousands of students all around the world, from retail through to hedge fund owners, institutions, banks, and there's even with kind of 3 generations deep into a plethora, if you like, of coaches who have coaching my process and system. So you may have come across me and not known about it. Again, back to the agenda, and we've got a few trades that I'd like to look at this week. We've had an interesting week. I'd like to start off with a few losers. I'm often not necessarily accused of, you never show the losers. I always show the losers in these Fridays. If we've had some losing trades, monetary losses, then they don't always work out. But what you should notice, again, broker statements are right there, not making it up. You can't hide behind the broker statements. It's right there. Sometimes the trades just don't do what we think they're going to do. But what you should see is that the losses are small. They're always small. They should be small. You should cut the losses quick. 2 ways of doing that. If we're looking at day trades, I want to be in and out very quickly. So I am going to close that trade early. And the swing trade one normally do with day trades is work the position size out based on the full price of an option, because I like to trade with stock options. Now, that means I can give it a little bit of wiggle room, a little bit of flexibility, because what we're seeing at the moment is the markets are up a day, they're down a day, they're up big a day, they're down big a day, they're yo-yoing around. So one of the advantages of options from a swing trade point of view is that I don't have to get involved for the stop loss at expiration if it's not working. That's it. Just wash my hands of it. It's just a more relaxed way of doing it. So anyway, these are day trades. I'm primarily focused on very short-term trading at the moment because of the markets and the reasons. But then there's just 2 or 3 trades from this week that didn't work out. The following one, and this is why we do it, this exact same setup, and this was an overnight trade, produced, again, a great result this week. We turned Again, these are all rebased to $250 risk so that you can kind of figure out where your situation is. But we had a nice overnight trade. It started off as a day trade. There was more in it. We held it overnight, and it turned out to be a clonker. So for $250 risk, you would have produced $2,350 out. Some student wins. Again, can this be replicated? Again, the big thing that I like to focus on is, can it be done? So Ruben, I know you're in the room. Just want to give you some accolades and well done and champion you. You've been a great student. You're doing excellent. Again, you're not the only one, but you're doing great. And there's lots of other students that are doing really, really well at the moment. Again, just want to call out to Duncan as well, doing absolutely awesome, just secretly smashing it in the background, along with all our other students who are doing exceptionally well. So again, just want to highlight that it can be replicated, and you can find your own path to trading success. For some people, just knowing that it can be done is enough for you to know that it can be done. Certainly from my point of view, knowing that other people, I used to read a lot of in the technical analysis of stocks and commodities. I used to subscribe to the magazine back in the 90s, and it was the first place I used to go to was the interviews. I don't know why I was always drawn to them, but nevertheless I was. And it was just nice to know that it can be done. The path, the road that I'm on, the road that I'm starting, the road that I'm traveling, there is a destination, and that destination is successful trading. It can be done. So just that knowledge in my early days, it kept me going. So that's why I show you these things. It can be done. It can be a business. It can be proven. Other people can do it. It's not just me. It can be done. So that's really what I like to get across with showing you these things. And let's take a little look at the markets. So let's think about what's going on. What's going on? Looking at the charts, it's crazy. It's batshit crazy. Up a day, down a day. What we have seen, and again, we've been commenting on this rising channel for a while now, and it's almost like the lower boundaries just hugging this 50-period moving average. This is the 200. This is the 60-minute chart, just for reference. But we've pretty much gone from the upper boundary of this rising channel down to the lower boundary. So it's still a correction. Again, just tying in line with what we'll be discussing later, it's still a correction. But how could you know that? Let me just change colors because I've been told that the white doesn't quite show up so well. How can we know that that was the upper boundary? If you'd not drawn that trend line, how do you know that that's the high of the move? How do you know that there's going to be a corrective move down? Similar to here, how do you know that there's going to be a corrective move down? Ultimately, we don't know. We don't know. No one truly knows. So what we need to do is make assumptions based on what history has done in the past to help us figure out what might happen in the future. So this is why we do things like draw trend lines. We look at Dow 3, GAN 3, Elliott Wave 3. I like to keep it simple. I really like to keep it simple. If it's not obvious, it's not there, is the way that I like to view these things. But sometimes we can draw on our knowledge, on our experience, on the things that I've seen over the last 25 years. How did we know that this was going on? Because I made a comment last Friday in the previous workshop. And then over the weekend, I was thinking about, but I was asked a question based on the comment. How do you know that there's a correction coming? How do you know that there's a retracement? I'm not talking about a crash, a sell-off. We've discussed that in previous workshops. When we looked at a 25-year study on stock market crashes. I'm talking about corrections, just a retracement in the context of an uptrend. And it might be a deeper retracement. But the question I was posed is like, how do you know that there's going to be a retracement? Like, other than gut feeling, the wind's changed, sticking your wet finger in the financial air and seeing which way it's going. You kind of get a feel for these things over a period of time. But then it got me thinking, like, how can someone who's at the newer end of the spectrum make that evaluation, make that assessment? And 2 or 3 times a year, I'm usually banging on the drum of corrections coming. It's going to keep going, be ready. It's going to happen. And then when it happens, everyone's shocked and surprised. Like, I'm not a genius when it comes to, as I like to say, I'm just a poor farm boy who figured a few things out and happened to make a good career from this. But it's not you don't have to be a genius to work all this out. You just have to be observant. I've seen it before is the answer. But what I'd like to try and explore now that we're back at the lower end, like, is the market crashing? No, it's done a retracement. It's probably going to move higher. And if it goes below these levels, and we've got the same levels on pretty much all the other, the Dow just doesn't seem to want to participate. NASDAQ's doing the similar thing. It's coming back to, again, not necessarily at a rising channel, but we've got this boundary low here. So we're at interesting levels. Again, Russell, just your classic retracement in an uptrend, prior resistance becoming support. So this sell-off, this retracement, it's nothing to worry about. But for a lot of newer traders, it may be the first time or you've not seen these types of retracements too often, because the stocks only go up. They only want to go up at the moment. But it can be unnerving if you're on the wrong side of a retracement, or if you've mistimed your trades and you're, oh, now I've got to sit through retracements. It can be very frustrating. Again, another reason why I like options, the pain stops. You're never going to lose more than the price of the option. Anyway, so let's explore that idea a bit more. Like, how do we know the correction is coming? How do we know the correction is coming? So that's the question I'm trying to answer. So that you can replicate it, so that you can go and do it yourself, so you can make these evaluations, so you can be the person in the room that made the accurate prediction of impending doom, or the stock market's going to retrace. So let's look at that. So when is the next correction coming? There should be coming on there. Now, I'd just like to point out, I actually first talked about this in my little insider community. And I did this on Saturday, the 25th. So last Saturday, when the markets were closed. And again, just pointing out the obvious, I'm not trying to do this with the benefit of this week's hindsight. I only do these workshops on a Friday. But we've been talking about this in our community for a while. We have a nice Slack community. If you're not a member, we have lots of free access. So if you want to kind of come along and join us, you'll get the replays to these shows. We've got some channels on various topics that we talk about. So that's where that was posted in Slack. There should be a link in all the emails that you receive from me to take you there. So what I'd like to then explore then is, how did I know on February the 20th, last Saturday, that there was going to be a correction? Unless you're a master at drawing trend lines, or Dow theory, or Gann theory, or Elliott wave theory, or any of the other theories and analysis, unless you're doing that and you've been doing it a while, you might not know that we were at the upper boundary of a rising channel on the S&P, or that we're in an expanding triangle on the Dow, or that we're in a retracement on the Russell and we're overextended, all the other discretionary elements. How do we take the discretion out? And how do we start looking at expectations, probability? How do we start thinking about, well, what's the likely scenario? What is statistically speaking? And we can start talking from data. Now, what I'm about to show you, it's observational, but it's cyclical. It's observational, but it's cyclical. And this is where all of my, not necessarily knowledge come from, but all of my observations come from, surprisingly, observations. Just saying, that's interesting. I'm making a note of it. Keep a diary, keep a journal, write these things down. I'm looking behind me on my shelves. I've got diaries, desk diaries. All I mean by that is notepads that go all the way back to 2002. And I would write my thoughts and ideas down, and not just to keep a track of my trades. Like, what are my observations? What's my current understanding of the market? So it starts off with observations. All of these things come from observations. Now, I'm looking at the blank charts. The dates of when this was taken, again, was last Saturday, the 20th of February. And what I'm going to do is I'm going to point out some obvious markers, just from a date point of view. And I refer to this as spot the difference. Does the bit on the left of the chart look like the bit on the right of the chart? Spot the difference. Does the completed picture remind me of the partial picture on the right side of the chart? And this is how we can start to develop ourselves as traders. It's how we can start to formulate forecasts, because as chart traders, we have got to believe that history repeats itself. And if you don't, you've got no business looking at the charts. Go and look at fundamental analysis. History repeats itself there as well. For the whole purpose of what we do as traders and investors, we're looking for things to happen again. The same footprint is how I normally refer to it. So that's what we're going to look at. So I'm going to point out again, so some obvious points. So the arrow on the left here, this one here, this is pointing at the financial crash. Now, that was the 20th of February, 2020. And all I was thinking about was over the weekend, it's the anniversary of said crash. Quite literally to the day, that's when it was. 20th of February, 2020. So on Saturday, 20th of February, 21, last week, I'm thinking, will history repeat itself? So let's focus our attention to the time here. So we've got 2020 down there. Let me just tidy this up a bit. So we've got 2020 down here. All I'm doing is highlighting the month there. I'm also like to point your attention to September, November. And then this last part on the chart, it's the same as the beginning of the year. We've got the beginning of the year and the end of the year. Sorry, the beginning of the year on the right side of the chart and the left side of the chart. So that's all that is. Like, will history repeat itself? So we've got to presume, or assume even, that because history repeats itself, will we see a downward movement? Will we see a correction? Is it plausible to expect a downward movement after the 20th of February? That's what I'm looking for, because it happened last year. Now, on last year, there was a crash. It was a little bit more than a correction. But we also see these cyclical retracements in between September, October, November, those kind of like between September and November, those 2 months there. And one of the reasons why I point that out is I'm often very vocal around October. For anyone who listens to the podcast or is in our insider community, I'm usually very vocal about that time of year, saying there's a correction coming. We're looking forward to a sell-off. It's probably going to happen. And this is why. So I was just trying to answer the question, how do you know? Open your eyes. Now, think about what happened last time. In this case, we're looking at things from a date point of view. Look at what happened last time and think, is it possible that it will happen again this time? Again, from a date or a time point of view. So these cycles do happen. History repeats itself, not just in the financial markets, but quite literally, history repeats itself. The same things, the same patterns, human behavior, psychology, it happens over and over and over again in the natural world. So it's probably going to happen in the financial markets because human nature drives the markets. So how did we know that there was going to be a retracement this week, a downward movement in the markets? Well, it happened quite literally exactly at the same date last year. Now let's look at the previous year. This is 2020 to 21. Let's look at 2019. I forgot to draw my arrows on. Let's look at 2019. That's what I was going to do. I had this fancy thing all prepared. So let me just highlight these arrows. And what I'm going to do is I'm going to copy them over. I did plan on doing this live. So the idea is I can't fudge it. I've not prepared. So I'm just going to copy these on my little slide thing. And as we go down the next slide, I'm just going to paste it over. So it's not obvious. So 2019 to 20, the previous year, if I just paste those things on, we've got to then say at about the same period of time. So over on the left, we've got the downdraft, the down movement. Now, it didn't quite happen in February, March. It happened a little bit earlier in December. Okay, so we're a little bit off the mark, a little bit early, if you like. Or if we were thinking about the October sell-off, well, we got the sell-off in October, the correction, the retracement. Uncannily, it happened. It happened. That's what we want. That's what we're expecting. So let's go on to the previous year, 2018 to 2019. Was there a sell-off at the beginning of the year and about October, November? Well, let's just click paste and let's see what happens. Oops. It suddenly becomes uncannily accurate to say, well, history is looking like it's repeating itself. Over on the left at the beginning of 2018, we got the big sell-off about February, March, quite literally at the turn of February, big sell-off. We actually have two sell-offs later on in March, April as well, but we got the one that we were wanting. The one that we were expecting is the point. The one that we were expecting. And then we're over in September, October. Well, lo and behold, we got the sell-off around about that time. Again, we got a second one as well later on in December, but it started in October. So we have the two sell-offs at the times that we were expecting. Let me just pause here, folks. Does this kind of resonate? Does this make sense? Is this starting to be a footprint for how to expect, and not just how to expect price to unfold, but when to expect price and history to repeat itself? So just pop a comment in the chat box. Let me know if we're all on the same page. Yeah, absolutely, Kevin. Yeah, it's going to help with future swing trades. So it can help you start to plan your portfolio management. You've heard of phrases like sell in May and go away. Well, maybe we can take advantage of short selling. We can maybe, if you're not into short selling, you can start thinking about managing profits, cutting the losses, running the winners, all the other things that we're talking about. Thanks, Rajesh. So we're talking about high level thing. It's a principle. And this is a principle that you can apply to anything. Again, we're just looking at this from the S&P. But it's going to help you figure out decisions and whether we should be biasing ourselves to the long side or the short side. Should we be bullish or bearish? Should we be in the market or out the market? Because sometimes knowing when not to trade, and especially if you're, because again, I know many traders, they have a bullish only portfolio. They've got a bullish only trading style. That's okay. I like to trade both sides when it's available, but maybe that's not your trading style. Maybe you just want to be an investor. You just want to be a, long only strategy. Maybe you want to do something different, but maybe this style, this viewpoint, these observations can help you formulate a plan. Maybe what you do is you wait for a February, March retracement as an investor. That's the time to get involved because there's often a retracement. Now, I would like to point out the next slide. There's not always a retracement. There's not always a correction. So over on the left of the chart at the beginning of 2017 this time, and the end is 2018, we didn't have anything, but yet on the following year, just going back a one, 2018 to 19, we had two. So it skipped a year, but we got two this year. I'm only expecting one of them either in February, March, or September, October time. I'm just expecting one correction. It normally happens, in a big-ish way, 10, 12, 15%, that sort of big-ish percent of retracement or correction. It normally happens once a year. Didn't happen this year. That's okay. But it happens most years. Happens most years. Can everyone see that? We got the sell-off at the beginning of the year. This is 2016 to 17 now. Happens at the beginning of the year. Almost regular as clockwork. Middle of the year, didn't quite get the sell-off, but it was a very slow, very lazy, eventual retracement. More of a time retracement. But nonetheless, it performed as expected. It didn't go up. It certainly retraced and moved lower, at least in a small way. Same thing again. This chart looks a little bit messy until you look at the times. Over on the left of the chart, it's going sideways, but there's multiple sell-offs in February, March. There's multiple sell-offs in September, October. You get the big one, the double test again. So what I'm hopefully pointing out is that the markets are cyclical. The markets prove themselves to be like this. And it's not just cherry picking the last 5-6 years, although I'm only going to go back through the last 6 years. So I've got two more slides, but you can see that history repeats itself. Hopefully that is very transparent. Coming back to the question, how do you know the market's going to correct? Open your eyes. You can answer this question for yourself. One last one, again, doesn't always happen, but hold on, it does kind of. We've got small retracements in February, March, a small retracement in September, October. These things happen all the time. So let's come back to the present day. This is again back to what I was looking at on Saturday, just gone, February 20th. How do I know that the market is going to correct? How do I know that the market is going to sell off? Well, firstly, I didn't. What I do know is that history repeats itself. And what I made a an assumption, because we had such a monumental market mover, and quite literally we have the 20th of Feb all the way back here. I presumed, because it was the 20th of Feb right here, that there was maybe going to be some anniversary nerves, anniversary jitters. And you see this thing, these anniversary times around the big crash date. So the 20th of February is going to be one of those days every year from now until the markets, well, I'm not sure that they're ever going to stop, but from now into eternity, every 20th of February, I'm going to guarantee there's going to be some commentary in the media, the news, about anniversary. Are we going to see a sell-off? Is there going to be a Black Monday? Will there be a Black? All that conversation. It happens in October. It's the anniversary of the 1987 crash. It's the anniversary of the 2008 crash. It happens around these anniversaries. Are there going to be market jitters? So to come back to the original question, will there be a correction? Well, there's always a correction. Always. It happens in a big way, once, sometimes twice a year. So we were due a deeper retracement. We've literally just had one this week. We got it right on the money. So how do we know? Well, history repeats itself. And again, if you don't believe me, we can go and look at a 75-year study. So this is looking back over seasonal trends. The data has been compiled over 75 years for the S&P. It's been detrended, so it's easy to see. So over a let me emphasize this, over a 75-year period, 75-year, this seasonal cyclical trend, and I've got the 20th of February there marked off. So 20th of February is kind of important from a historical viewpoint. There's probably going to be a sell-off all the way down to maybe the end of March. So these are all the kind of the compiled data, looking at averages. It's detrended, and you can see price move downwards in that time period. And here's our September-October period. It does happen, in the summertime, but the one that we've observed, my personal observation, is the September-October sell-off. Well, there we go. It normally happens. It normally happens is the point. So what can we do with this data? Well, firstly, we can expand it out. We've made an observation, first of all, and now we're looking at all the seasonal cyclical data over 75 years. And we could, if we wanted to, just look at the last 10 years, the last 25 years, the last X number of years. I'm just looking at all the data just to kind of aggregate it all together to show long-term seasonal cyclical trends. Well, maybe we don't worry about the crashes or the corrections because, hey, February, March, it can be a bit tricky, but certainly at the beginning of March, maybe that's the time to load up the boats. Maybe if you're looking to build a portfolio and you're looking to kind of hit the ground running with your best foot forward and all that jazz, maybe the end of March is the time to start thinking about looking for bullish candidates in a bullish market for your bullish portfolio. That's going to be the time after that February, March correction, crash, retracements, whatever it turns out, because we don't know what it's going to be. It might not even happen. But if we're waiting for the best possible time to think about investing or trading or looking for the best opportunity, then there's the opportunity right there. We've got same situation here. If we wanted to hit the last quarter of the year hard, maybe end of September, beginning of October, historically speaking, is going to give us best foot forward opportunity. Maybe you can start planning your year. If you've got less time under normal circumstances to start thinking about trading and investing, whether it's day trading, whether it's swing trading, whether it's investing, because you can use all this information in all of the different ways, all the different mediums. It just needs to be like, how am I going to use this for day trading? How am I going to use this for swing trading? How am I going to use this for insert your thing, investing, trading, swing trading? How can I profit from the short side and profit from that expected downward movement? Yes, you can. So how can we use this? Maybe if you've got less time, what you can start doing is planning on your calendar. Maybe you get it on your calendar that for that month, you're going to have some time in the day on your calendar around your regular schedule to pay a little bit more attention to the markets. If you've got less time, if you've got more time, maybe this is a time where you're more aggressive on the bullish trades, the bullish investments, even on the day trades, because there's a general upward bias. So maybe on bullish trades, just think about from a day trade point of view, because that's my focus right now. Maybe what I do is, instead of 0.5% of my account equity per trade, maybe what I do is I go to 1 to 2% and only do extra or increased position size on the bullish side. That's a way that you can use this information even day trading, because there's a likely upward incline on that time period. So I can take advantage, even as a day trader or a short-term swing trader, and go with the general flow of the market to try and take advantage of seasonal swings, cyclical information. And certainly from a bearish point of view, if there's going to be bearish trades during that period, maybe I do the opposite. Maybe I either reduce my bullish exposure and start looking more intentionally for bearish exposure. And maybe not only that, I can start to think about increasing position size on the bearish side. So these seasonal cyclical swings in the markets, they can help you. Doesn't matter whether day trading, short-term swing trading, get paid at the end of the day, the end of the week, the end of the month, the end of the quarter, the end of the year, whatever time horizon that you're looking at, it can help you if you understand the seasonal and cyclical nature of the markets. Right, so that I've got to admit, folks, that was all I wanted to. That's all I've got to say on that. Is the correction coming? Well, the big secrets, it's always coming. It's always coming. So now that you know what I know, and you can start making those observations, then you can start making note of them and taking advantage of them. If you'd like some help with what I'm currently referring to as the perfect trade system, I'm coming more and more around to this. It's the same process. I refer to everything that I do as a production line. And as my understanding of it develops and the understanding of my own system gets greater, you know, all those little nuances, it becomes more and more like a production line. And what I'm finding at the moment is I'm trading less and less, but the quality of the trades is getting better and better. So that's why I keep referring to it as a perfect trade system. The good news is it's a production line. It's an algorithm. It's a series of yes, no statements. Has this happened, yes or no? Because then it doesn't matter whether you're at the newer end of the spectrum. There's obviously going to be a learning curve. I'm not going to deny that. But you've got this ability to find, filter, and sort good trades with a systematic process, regardless of your experience. And that's kind of where I'm at in my career as an educator and as a trader. So if you need help with profiting from the open, from short-term explosive movements, and you want to learn in the smartest possible way, and you want to learn how to focus on the best times to trade, we're going to look at some examples right now. You can learn one simple pattern. We've got 9 variations of it, but there's essentially one simple pattern. You should be able to learn this in the next 7 days in just an hour a day. All the money management that goes into it, of when to get in, when to get out, if it's working or not working. And once you've mastered it, you should be able to see results in the next 90 days or less. I'll work with you until you're seeing results. And most of my students see results very, very quickly. You know, we went through some examples of them earlier. You know, these are not just, it's not just me showing you these trades. You know, there's lots of my students are, there we go, some more student wins. They're all able to replicate this process. So that's what I want to kind of leave you with. That thought of, can it be done? Can it be replicated? But sometimes people need a little bit more help, and that's what I'm offering. If you want the help, it's there. You'll never stress over which way the markets are going, as we've just been. It doesn't matter whether it's correcting, it doesn't matter whether it's booming to the moon, whether it's crashing, whether it's correcting. You should profit in both directions. That's what a good strategy should do, whether it's day trading or swing trading. You won't be spending hours flicking through chart after chart. As you see me do on these Friday sessions, it takes longer to explain than to actually do. We're going to go and look at it in just a moment. And you'll never read through boring company reports, because I hate doing that. So if you want help with any or all of that, I don't know if what I do is right for you. Let's just start the conversation. You can send an email to phil@antivestor.com, or you can go to my website, antivestor.com. Choose your own adventure. If you're at the newer end of the spectrum and you'd like to learn what a chart is, and those fancy squiggly lines are, just go to the I Need Basics. If you'd like to learn the day trading strategy, which is what I've been focusing on for the last several months and talking about on these workshops, I'm still swing trading. We tend to do the swing trading in the day trading program as well. And in both cases, I've got a live session where you can log in every day. You can look over my shoulder and see what I'm doing as I'm doing it. So you can choose your own adventure. If you need a little bit more help, it'll tell you what you can do next.